we'll kick it off. So welcome everyone. Thank you very much for joining us. We've been waiting a long time to do this, and we're really excited at the opportunity to get into the LSRS and what its publication means in practice. As I'm sure you're all aware, it is a long and complex standard, so we're not going to be able to cover everything in detail, but we're also aware that there's been a lot of discussion, understandably, since it came out, a lot of articles, other webinars, and fairly wide coverage of, I think, the main changes and updates. So we're trying to focus here on specific issues and priorities where possible, to really, I guess, have an opportunity to get into more detail. We've structured the webinar in 3 sections, so we'll do a very brief reminder of what is the LSRS, how does it fit in, where has it come from and why it matters. We'll then go through a top-line summary of the key changes, talk you through those. But then we'd like to spend most of our time exploring what this means in practice. So what are the real-world implications for the alignment with the LSRS, things like, how do removals really work now? What does it mean for my Reach and Ag program? What does it mean for my flag target? We have assumed a baseline familiarity with the topic with the hope that by essentially getting right into it and a little bit technical, we'll be able to provide some more useful and practical insights. A little bit of housekeeping first. So the webinar is being recorded and we'll share it with everyone afterwards, probably sometime early next week, depending on how long it takes us to upload it. We are aiming to do a Q&A at the end. We're aiming to save around 15 minutes for that. We'll use the Zoom Q&A function for that, which you should see at the bottom menu. Questions can be asked anonymously if you'd like to, and please do feel free to use it throughout the webinar to ask questions as they occur to you on a particular topic. My colleague Alwyn will be facilitating the Q&A, so she'll be in the background pulling them together. We'll try to group by themes where possible, assuming we'll have a fair number of questions and then answer more that way if we can. We're also aware that the WRI webinar starts immediately after this, and we imagine many of you want to go to that as well, so we will be sure to keep on time and let you go in time for that. Next slide, please, Emily. So over the next few slides, I'm just going to spend a little bit of time introducing us and particularly what our background and experience is in this area, so you know where we're coming from, particularly when we make recommendations and prioritize things. So 3 Keels is a sustainability consultancy. We are based in the UK, but we work globally, primarily in FMCG and natural resource supply chains. We operate across 3 sort of thematic areas. We have significant climate expertise. We support organizations on understanding climate risk, setting those net zero targets that this LSRS is hopefully feeding into, developing decarbonization roadmaps. We're global leaders on commodities and deforestation. We manage large and complex programs to improve traceability in commodity supply chains and also to support on deforestation target setting and achievement. And finally, we have significant practical experience in agriculture and supply chains. And if you go to the next slide, I'll talk a bit more about our team here, which is where we focus on action and implementation. So once you've understood your risks, set some targets, or you've identified priority supply chains and landscapes, how do you actually do something there? How do you achieve what you want to achieve? We work across our whole business to bring that expertise to all of our projects. Particular relevant experience that we have in this area, LSRS and land accounting, is our work on defining and developing best practice for insetting at different levels, including for Conservation International and the UK government. We support the strategic development of the MRV program for the Landscape Enterprise Network, so we're actually doing it, putting it into practice. And we act as the Secretariat for the Carbon Removals Task Force, which is a UK-based collaborative initiative of businesses working together to explore essentially challenges in implementing this. Next slide, please, Emily. And just quickly, we're really proud to have been recognized as leading management consultants in sustainability by the Financial Times for 8 years now, and particularly of our status as a B Corp. Next slide, please. There are 3 of us here from 3 Keel presenting this webinar today. So my name is Catherine. I'm the head of the Agriculture and Landscapes unit. I have a practical background in agriculture. I'm a former farmer myself, and my expertise is broadly in regenerative agriculture, program design and strategy, and MRV. Delivering the webinar with me is my colleague Megan MacGillivray. She's a senior consultant in my team, and she's delivered a lot of projects supporting clients in understanding removals implementation and reporting requirements, including on LSRS alignment for RAP. And then rounding out our team today is my colleague Alwyn Smith. She's a principal consultant in our climate, nature and resources team, and her expertise is in corporate climate strategy, which includes flag target setting and transition planning and risk. She'll be facilitating the Q&A when we come to it at the end. Next slide, please, Emily. So we're going to get right into it, and I'm going to go to Megan initially to help us set the scene with the relevant background of the LSRS. So next slide, please.
Thanks. Yeah, so to really understand the impact of the new land sector removal standard, I think it's useful to take a bit of a step back and review how it fits into the broader landscape of standards and guidance. And for corporate climate targets, there's two key organisations dictating the rules. The first is the Greenhouse Gas Protocol, which defines the rules for corporate greenhouse gas accounting and reporting. And the Greenhouse Gas Protocol has many standards for specific industries, and the ones that are most relevant to the land-based sector are the Greenhouse Gas Protocol Scope 3 standard, which is known as the Corporate Value Chain Standard, and the new Land Sector Removal Standard. The second organisation is the Science Based Targets Initiative, which defines corporate greenhouse gas target setting and really defines the scale of emissions reductions and removals that are needed to align with the Paris goals. And the key standards here are the Net Zero Standard and the Forest, Land and Agriculture Guidance. These two sets of standards and guidance rely on each other, with the Science Based Targets Initiative largely deferring to the Greenhouse Gas Protocol for more detailed accounting guidance. But alongside detailed accounting guidance, the next slide outlines several goals that the standard can help organisations achieve, from calculating their land-based emissions and removals inventory, which can help them identify emissions-related hotspots and risks, but also mitigation opportunities to address these areas of risk. Secondly, the standard can help organisations capture changes in that greenhouse gas inventory over time and support reporting against SBTs. But the most important things that we'd like to call out today is that the LSRS can really support organisations with how to inform strategies to reduce land-based emissions and increase removals. So that could include insetting and regenerative agriculture projects, and how organisations should report and disclose these activities. So today we'll really focus in on the implications of the Land Sector Removal Standard on those implications. Yeah, thank you. The first draft of the Land Sector Removal Standard, so at the time it was called the Land Sector Removals Guidance, was published in September 2022, after which the guidance went through a period of pilot testing and revision. And that was quite a long consultative process with, technical working groups, advisory committees, to get to the place where we are today with the publication of the standard 2 weeks ago. The standard was really consolidated and is now focused around 32 requirements around how to account and report for greenhouse gas emissions, removals, and other relevant metrics. And they've stripped out a lot of the additional detail that was originally housed in the first draft. And this will now be housed in an additional guidance document that's expected in Q2 2026. And that will provide more comprehensive guidance on actually implementing the requirements and recommendations. So it's going to include case studies, examples, and calculation guidance. The standard comes into force on the 1st of January 2027. And after that point, organisations will need to be aligning with Land Sector Removal Standard requirements to report. And we expect that the Land Sector Removal Standard will continue to evolve, but at this point, we're not expecting any major overhauls, as this was, quite a long consultative process. And many organisations have actually already started to move forward based on the original guidance. However, as we'll explore at the end of today's session, there are relevant work streams that are ongoing under both the Greenhouse Gas Protocol and the Science Based Targets Initiative that might offer more routes to reporting impacts of land-based mitigation activities like insetting and regenerative agriculture that sit outside of the physical Scope 3 inventory that the Land Sector Removal Standard really focuses on. So we'll now move into our summary of the key updates to the Land Sector Removal Standard.
Thanks, Megan. If you go to the next slide, Emily. So in this section, we're just going to go through key updates, key changes that we think you should be aware of. We'll touch on implications here and there, but then the next section is really that will be the focus there. So I'm going to start with land use change accounting. So the updated LSRS has a lot of really welcome clarity here. For a long time, there's been a lot of uncertainty around how to calculate and account for land use emissions, land use change emissions. There's been some tensions between carbon accounting rules, which require a 20-year time period, and certifications for deforestation-free, for example, or sustainable production that have various cutoff times. So this update provides clarity that you can't just assume that a certification zeroes out land use change. The time periods have to match. And the updated methods also allow better granularity to capture what's actually happening. They do this in part through adding a new calculation, optional calculation approach, which is jurisdictional direct land use change, which allows you essentially to have a more accurate picture of what's happening rather than just relying on secondary factors, which may overestimate what's happening or underestimate what's happening. There are some new metrics in terms of alignment. They are land occupation and land carbon leakage. The land occupation metric is quite simple. It's just total hectares of land in production, which can be achieved by essentially yield proxy calculations. The requirement is just for the total amount, but it is recommended that you disaggregate that if possible by land use, by management type or land use type. The land carbon leakage reporting is a little less sort of straightforward. The need to account for that is triggered by high leakage risk activities. There are 3 of those. One is the use of food or feed crops for non-food or feed uses, aka biofuels primarily, or land management change practices or removals that result in a significant reduction in food production yield. And we'll come on to the implications of that later. But it's actually probably not as complicated and risky as it might sound initially. However, the required accounting methodology, if you do need to report leakage, is very conservative. You essentially have to assume that any leakage is converting natural vegetation to food production. On land management emissions, we have confirmation of a stock change accounting approach. So you need to split your emissions into stock change by various pools and sources of emissions. There's a clearer separation of biogenic and production land management emissions, and they provide recommendations for allocations across crop rotations. So they're not requirements, but they are sort of a recommendation for best practice, which hopefully supports particularly areas where supply chains may be collaborating sort of at the same supply chain tiers on climate mitigation activities and want to understand the best way to allocate the emissions. Next slide, please. On biogenic product emissions, I think the main update here is that biogenic carbon dioxide from biofuel combustion can still be reported outside of Scope 1, but there are some new guardrails. So, the full life cycle of the biofuel greenhouse gas emissions must be reported, as well as any leakage associated with that. Forestry, probably one that you're all aware of, as it has been reported most places. So the LSRS does not apply to forestry accounting in this version. It was a sort of long outstanding question that I think contributed to the delay of the publication, in general. And essentially the issue is that they feel that they cannot yet tease out which emissions and removals associated with forests are anthropogenic and therefore should be accounted for in a physical scope 3 inventory. So this may apply in a future LSRS, but they also told us essentially don't hold your breath on this, and that it's going to take a while. So don't wait for it, just be transparent on your reporting. It does include adjacent and proximate lands, which in turn includes things like agroforestry and hedgerows, which we think has fairly significant implications, and we'll come on to those later. But in sum, you can have activities here, you can report on them transparently, but they cannot go into your physical scope 3 inventory at this point. Finally, we wanted to call out greenhouse gas credits. As we know, there are lots of questions in that area. So it does have a chapter on credits, but only on credits which are created within your value chain or operations are in scope of the LSRS. So they do not have a view, and they're not going to provide guidance. It's not within their scope to talk about credits that are created outside of your value chain, essentially, and how they may or may not interact with your inventory or against targets. Essentially, the situation we're talking about here is when you might have farmers in your supply chain who have used part of their land independently to develop carbon credits and then sold those credits elsewhere. That's the most likely scenario here. In that case, they want you to be aware of those credits and then report your inventory twice, basically. One, just your full physical inventory, and then one adjusted for the credits that have been issued. Double counting is really important to avoid here, and we'll come on to that a bit more later. They do differentiate between inset credits and greenhouse gas credits, but don't provide further clarity at this point on what is the difference between the two and what an inset credit is. We imagine there will be more information on this in the guidance, and they do provide some additional quality criteria for credit generation. Next slide, please. Thank you. So one of the things that is new-ish in the LSRS is this concept of a greenhouse gas report. So reporting alongside the physical inventory already exists. This is something that happens with science-based targets. But this sort of reference to a specific consolidated standalone greenhouse gas report is new. It's mentioned nearly 30 times in the LSRS. They talk about a company's GHG report reported in your GHG report. So essentially what this is it serves as a landing ground for all of those requirements that sit outside of the physical inventory. And there are quite a lot. A lot of the 32 requirements in the LSRS are disclosure requirements that are outside of the inventory. And these are things like justifications for the level of traceability you're using, the methods you're using, the approach, a lot of your choices. This creates a sort of dedicated space to this. They do recommend assurance. It is not required, but when they talk about assurance against the LSRS, they are talking about the greenhouse gas report, the whole thing, not just the inventory is assured. We actually see this as a positive thing. Obviously, it creates more administrative and reporting burden. It asks for quite a lot, but it also gives you the space to justify the choices that you've made, which may provide some flexibility in terms of places where you've needed to make pragmatic decisions that you feel align to the best of your ability. You can justify that here. There's some scope for that. It's also a potential pathway because it includes some level of dual ledger reporting anyway with the credits I talked about on the previous slide to increase the validity of and incentives for reporting approaches that are outside of the inventory, such as impact traceability, which we'll talk about more later on, and ongoing emissions responsibility. So areas where a lot of mitigation activity might happen just outside of your supply chain, your value chain, and it's really hard to capture that impact or incentivize it because it's not going against your target right now. But if it becomes a sort of more important aspect of reporting, then there's a lot of potential there. Next slide, please. I'll hand over to Megan now on the traceability side.
Thanks. Yeah, the final area of really key updates and foundational concepts that we wanted to cover today were ideas around spatial boundaries and traceability that were first introduced in the land sector removals guidance, but clarified and modified for the land sector removals standard. Land-based carbon accounting depends on defining a spatial boundary, and spatial boundaries kind of the specific geographical lands that are included when a company is accounting for the greenhouse gas emissions and removals. And for Scope 3 reporting, that boundary is directly tied to the organisation's level of physical traceability to the origin of the products sourced. So the LSRS outlines 5 key spatial boundaries, all the way from global, where an organisation has no specific knowledge of the origin of the products that they source, all the way to a harvested area boundary. So that's a subplot of a farm that was actually harvested to produce the product sourced. And the two key things to draw out here, the first is that the LSRS updated the definition of a sourcing region. So that's the land area representing the supply shed of a first point of aggregation in the value chain. And that can now actually include multiple first points of aggregation where they overlap. So we see this as a positive development that can support implementation. And the second key update is around the land management unit spatial boundary, which is, I guess, for all intents and purposes, the farm. And this boundary has been expanded to include both the productive areas of the farm, such as fields or grazing lands, but also adjacent and proximate non-productive lands, such as hedgerows, buffers, and woodland. And the LSRS outlines several safeguards for incorporating impacts on these areas into corporate accounting. But due to the, I guess, like unresolved forestry accounting questions that Catherine referred to, the LSRS states that these need to be reported outside of the physical inventory for now. And this spatial boundary of accounting is really crucial because it determines how you will account for both land management emissions, land use change emissions, but also removals. So you can see in the table here that defining the spatial boundary is really the first important step in applying the standard. In the next slide, we explore how you actually prove traceability to a specific spatial boundary. And organizations need to prove physical traceability through an accepted chain of custody model. So the land sector removal standard has provided quite a lot of clarity in this area. So they've really built on work done by ICL and the Value Change Initiative to define what physical traceability actually means. So generally, traceability is the ability to follow a product all the way back to the farms or landscapes in which it was produced. And there are various ways of proving traceability, but the land sector removal standard focuses on one, which is a chain of custody system. And that tracks how products move between different entities throughout the value chain. And it starts at production and tracks the product through the value chain until it reaches the final end user. And crucially, the land sector removal standard outlines that some chain of custody models are acceptable for proving physical traceability, whilst others aren't. And the key question here is, to what extent does the chain of custody ensure that the material being accounted for is actually being purchased by the reporting organisation? So as you can see in the diagram on the slide, chain of custody models can either prove a direct physical relationship if using identity preserved, segregated or controlled blending models, where the materials being accounted for are definitely being sourced by the organisation. They're present in the materials being sourced. Or chain of custody models can prove physical connectivity through mass balance, where as materials are mixed across greater scales or greater temporal periods, the likelihood of the material actually being in the volumes bought by the reporting company becomes smaller and smaller. So because of that variability within mass balance models, the land sector removal standard outlines safeguards around what kinds of mass balance model are allowed. So they require a defined reconciliation period, and mixing is restricted to sites within the same country and sourcing region. So that's a really crucial safeguard there. And characteristics also have to be assigned using proportional allocation. So that's another key safeguard in place in terms of mass balance reporting. The land sector removal standard does say that chains of custodies can be implemented through either certification routes, but also through internal management systems, as long as they're audited. So we feel like this is like a strong signal that these traceability requirements are really central to capturing the impacts of any activities implemented in the supply chain. And they don't need to be certified, but they do need to be implemented to track volumes and avoid overclaiming from the impacts of regenerative agriculture and insetting projects. And the final point to point out in terms of traceability is that the idea of impact traceability is again introduced in the land sector removal standard, as it was in the land sector removals guidance, but not fully defined. And it's kind of unclear at this point how impact traceability sits alongside these requirements for physical traceability. And the key area that the land sector removals standard did provide guidance on is that currently, for any organisations using impact traceability, where the impact is kind of separated from the volumes being sourced, they must be captured using outside of the physical inventory in the greenhouse gas report that Catherine was referring to. Next slide, please. So aligning with the land sector removal standard is, context dependent. It will depend on your operations. And so we thought it'd be useful to explore a few of the key issues and scenarios where the LSRS might impact your activities and what some of those implications might be for implementation. So the first key question is, how does this impact my SBTI flag targets? So as we pointed out at the start, there's a lot of interplay between the two standards. And from January 2027, accounting will need to reflect the LSRS requirements. And this could potentially cause a discrepancy between the methods used in the base year and follow-on footprints. So our view is that you only need to revalidate your existing flag SBT if the application of the new LSRS requirements compromises your existing target. So that means that you'd actually have a different target based on your new base year inventory that aligns with the land sector removal standard. For flag sector pathway targets, so those that are based on absolute percentage reduction, we feel that those are unlikely to be compromised, as new methods would not be that likely to change the makeup or activities included in the target pathway. Whereas for flag commodity targets, so intensity targets, these would be more likely to be compromised if the mix of removals and land use change is different in the base year. So an example of that is if you've set a flag science-based target, commodity target for reducing maize emissions by, say, 40%, that is calculated through the SBTI tool based on the mix of land use change, land management, and removals emissions within that footprint. But if you apply the land sector removal standard and new methods mean that the mix of emissions changes, then your percentage reduction target might also change. So that's something very crucial to consider. Next slide, please.
Thanks. So I'm going to talk a little bit about implications for reporting removals, because that's obviously a large piece of the land sector and removals standard, and it's a really complex area. It's an area that we know lots of food sector businesses are really interested in, but not acting on yet necessarily, because of the uncertainty before this was standardized, and also the complexity of aligning. So some of the things that we think come out of this finalization, so the requirement to demonstrate permanence remains, and to be able to continually monitor your removals, but they have provided several options for how you can do that we do think genuinely adds flexibility and feasibility. These include buffer pools, which you can manage collaboratively or have managed by third parties, but you must maintain your own, or there must be a separate pool for you in the collaboratively managed buffer pool. Those really can reduce and buffer risk against reversals of removals. And then also monitoring periods, which is this idea of, you report a removal and it will be monitored for 5 years or 10 years, and you have a plan on how, a plan already on how you will handle it at the end of the monitoring period. You may renew it consecutively, or you may replace it with other removals at that point in time. Administrative burden and resource burden is a perpetual concern with MRV, and these options definitely add feasibility, but they also add potential administrative burden. So this is one area where we think that collaboration can support reducing that. Also a good argument for better carbon registries, national, universal, sort of third-party managed carbon registries, which would also help avoid double counting, which is a big requirement. Reversals, they've elaborated on how do you report a reversal if it occurs, and they split it into 2 scenarios. So if the removals, the carbon stock pool is still in your inventory at that point, so you're still sourcing from that sourcing region or land management unit, then you would report it in that year as a land management net biogenic CO2 emission. If it is no longer in your inventory, if it is no longer in your scope, because, for example, your supply chain has shifted, then you at that point report it as a reversal of land management carbon dioxide removals. This also happens if you are no longer able to monitor it. And these reversals are reported outside of your inventory in your greenhouse gas report. They do ask that you set a reversals policy, a reversals accounting policy. This is theoretically supposed to determine how those reversals are accounted towards a target that you have, but it would not go into your inventory, so it's not clear how, or even if it would meaningfully affect your flag target, for example. We see this actually as a risk reduction in terms of accounting for removals, in that previously there was a big concern that if your supply chain moved, you'd have stranded assets in the form of removals. And this mitigates that to some degree. I think it still needs to be explored, but it was a real concern because supply chains can be fluid, they move. And removals can require a lot of investment to be able to report. The inability to report removals in adjacent and proximate lands in your inventory right now, we do think that this reduces the size of the opportunity around removals for some supply chains. For some supply chains, it will be in those trees and those hedgerows and those buffer strips where the real opportunity for removals is, rather than in infield measures. So that's not saying there won't be removals, but the size may be different, and that will change your calculation into where it's worth investing, essentially. The data quality requirements are high. There's been a switch in terminology from primary to empirical data, which should hopefully provide some clarity on what's allowed. But this is definitely an area where we think there will be a lot more clarity in the guidance that is upcoming in terms of what really counts. And then a big theme throughout the whole standard, but particularly with removals, is avoiding double counting and avoiding over allocation of removals. This is another area where collaboration will really support the ability to comply if that is an opportunity or an option for you. That's both, down through your supply chain and across at more horizontal levels with peers. The LSRS does offer up this idea of the right to report as a potential option for addressing double counting, and that's essentially the idea that you get explicit consent from the land manager or landowner where the carbon removal is occurring, and that consent ladders up. It should be given freely with informed prior consent, but it's not a requirement. Is it offered as an option for helping you manage this? Next slide, please. We also wanted to talk about the implication for regenerative agriculture programs, because we know a lot of you will be implementing these, or looking at implementing these for a whole host of reasons. It's not just about sort of achieving climate targets, but there are a lot of implications for those programs in the LSRS. On the accounting side, there is clarity on land management and land use change accounting. That is helpful, particularly when designing your programs and designing the MRV for them. There is, because of the clarification around a stock change approach, there might be a potential challenge initially with the readiness of databases, farm greenhouse gas calculators that don't always report on that split. It's not something we anticipate being an issue for long, because they're all going to update to align with the LSRS now that it is available, but it is worth a conversation. In general, we know that most people are going to interact with farm data via farm carbon calculators, via databases, specialist data sets, or service providers. So in general, we really recommend, and it's really important to seek assurances from them that their data is, or their methodology is, LSRS aligned. This is a specific question that you can ask, but in general, that is good practice. Regenerative agriculture practices may trigger the requirement to calculate leakage emissions, as one of the buckets is essentially land management changes that might reduce yield. But the key things here are that it would have to be a significant drop in yield to trigger it. They don't define significance in this context, but particularly that there is an exemption for changes that are, quote unquote, made to improve the long-term sustainability of food production. Given that the primary objective of a regenerative agriculture program is, or should be, the long-term sustainability of food production, we think that this is probably going to be a fairly easy one to make a justification for not needing to make this leakage calculation. On the implementation side of things, we do think there's improved feasibility now of removals monitoring and meeting that permanence requirement. We do worry that there are potential perverse incentives for whole farm action. Regenerative agriculture generally looks at whole farm management. You want to be managing across an ecosystem. Taking away the ability to report in your inventory for adjacent and proximate lands, particularly for things like agroforestry, hedgerows, buffer strips, is a potential perverse incentive to ignore those in favor of the things that you can definitely report in your inventory. Obviously, we think that that would be a mistake, and that there's a lot more benefits than your climate mitigation, a flag target, to be doing these activities. But it is something to look out for, I think, and that's also where upcoming ways to report climate mitigation activities outside of your inventory are going to be increasingly important. Supply chain relationships, strengthening them, lengthening them, their duration, is going to be really helpful in supporting, meeting the requirement around avoiding double counting, also around over allocation. And then finally on traceability, so we think that in general, the inclusion of the mass balance model supports implementation in complex supply chains. We do a lot of work in commodity supply chains. They're incredibly long and complex, and land management unit traceability is not going to be possible in all of them. That said, it is important to pay attention, especially in both reporting, but in emissions reporting for regenerative agriculture programs. When you are reporting at sourcing region, there is a requirement to account for all attributable productive lands in that sourcing region. So that will include the lands that are in your regenerative agriculture program, and it will include the lands that are not. And if the lands that are not in your program are significant enough, then there is a risk that they can dilute the positive impact from your regenerative agriculture program. Essentially, they will sort of balance out the lower emissions factor you might achieve with your regenerative agriculture program if your sourcing region is really large, for example. And so that is a potential, that's a watch out essentially for emissions reporting from regenerative agriculture programs, and something to look at closely. Next slide, please. In terms of key takeaways, in general, we think it provides much needed clarity on an area of accounting where there just were not clear rules yet. And that's a really positive thing. There are some really important guardrails in there to ensure robustness, which is really important. We want to make sure that the claims that we are making are grounded in fact, and that we are actually having the mitigation effect that we hope we are having. But it is a really high bar for alignment, and it is going to be complex and complicated, particularly in certain supply chains. Others it will be easier for. And so there are decisions to be made about what you prioritize and where you put your investment when you want to align. Overall, there are clear themes throughout the LSRS of continuous improvement and increased transparency. They ask for a lot of justifications and information, and there's a real push to continually improving traceability, for example, data quality. We do think that the fact that so many justifications are required does give you the opportunity to make those justifications in the first place, and hopefully the opportunity in places to make more pragmatic decisions. And then it almost goes without saying, but the upcoming guidance is definitely going to be vital for further clarity on implementation. And I know that I personally, at least, am very excited to dive into that as well, because I am a nerd. And I will pass over to Megan on that note for the next slide.
Thanks. So yeah, one of the key points that Catherine mentioned there is some of the challenges in terms of full implementation of the land sector removal standard. And, we're recognizing that it is complex and full alignment will be challenging in some contexts, and particularly in some supply chains. And alongside that, we also have the areas where there are potential disincentives that whole farm action embedded within the standards. So particularly around adjacent and proximate lands. And our key message here is that, strategic business needs like resilience or nature or water should continue to be the primary driver for action. And whilst the land sector removal standard determines what can be accounted for against Scope 3 targets, it shouldn't necessarily dictate the full project design, which should be more based on whole farm transformation and transition to more resilient production systems. And when we're thinking about that kind of prioritization and where should we act and where should we invest, we would suggest using kind of supply chain assessments to prioritize and focus efforts and investment on improving traceability and data robustness in those supply chains where it is most suitable for reporting and where you will have most impact. So the diagram shows some of the factors that might impact your decisions on where to invest, and that can include materiality to your overall Scope 3 footprint, the mitigation potential of activities within that particular supply chain, but also the potential to deliver co-benefits. And other kind of more practical factors include like opportunities for collaboration with other supply chain actors, supplier relationships, traceability, and supply chain stability. And together, those are the factors that we think make it most worth investing in traceability models and data collections. And for those supply chains where Scope 3 reporting might not be suitable due to smaller mitigation potential or challenges proving physical traceability, we feel that there are future pathways that might provide alternative routes for action. So although they may not be suitable for full investment under the land sector removal standard, we're seeing a transition in that direction through other mechanisms. And yeah, next slide, please. So as we mentioned, there are a lot of requirements embedded within land sector removal standard, and all of them are important for full alignment. But this slide outlines some of our views on the prioritisation of actions needed to align with the land sector removal standard. So the key high priority actions include for removals, this is the first time we have strong safeguards in place for reporting removals, including, the need for empirical data, the need for traceability to at least the sourcing region. And there are a lot of databases and tools out there that include misaligned removals, so where there's no primary data or no traceability. So this is going to be a really key area for organizations to review and resolve. And a kind of similar principle applies to land use change, where a lot of organizations use either generic or unrepresentative numbers that have been used in baselines that can either, overestimate land use change emissions or potentially zeroing out land use change emissions where they shouldn't be due to certification. So that's really another area to review and ensure alignment. And then finally, around biofuels, this is an area that we get a lot of questions around. And there's also a lot of uncertainty. And we think applying the land sector removal standards requirements here will ensure that you're quantifying the full life cycle of the biofuel and reporting it as part of scope 3 and also using the leakage calculations. So those are the kind of key priority actions. And then we also outline some of the areas of alignment that might require more long-term activity. And the first of that is the avoidance of double credit counting. And we think, this is still a really key area, but how it's done in practice and managed is quite complex. And we'll recommend that, the initial approach will be around asking the right questions of farmers, suppliers, data providers about double counting, and then in the longer term, moving towards full compliance with the land sector removal standards requirements. The second kind of similar point is around land management CO2 emissions. And this can be an important source of emissions, for example, in like agriculture on peat soils. And it's not commonly included in footprints, and farm carbon calculators can sometimes leave this out. So it's difficult to address, and as the barrier doesn't necessarily sit with the reporting organisation. So it's something to kind of bear in mind in the longer term. And then finally, the land occupation leakage metrics are classed here as medium priority, and they'll likely need new processes within your organizations and take some time to kind of implement and understand the recommended approaches here. And then finally, there's a load of other mainly reporting requirements if you want to fully conform to the standard and make the decision to do that. So final slide from us. As we've alluded to at various points throughout the webinar, the land sector removal standard sits within this wider landscape of standards that continues to shape the future of corporate climate reporting. And it includes various work streams that we won't go into in too much detail, but includes the Greenhouse Gas Protocol, Land Sector Removal Standard Guidance, and the Action and Market Instruments working groups, as well as the SBTI Corporate Net Zero Standard version 2 and FLAG version 2 updates. And the key things being covered under those work streams include the opportunity to include credits and environmental attribute certificates, and also exploring where necessarily reporting through physical greenhouse gas inventories might not work as well. So, long commoditized supply chains and exploring alternative pathways for corporate climate claims under those supply chains, including kind of ongoing emissions responsibilities targets that might sit outside of scope 3 targets.
Thanks, Megan. Next slide, please. So we are aware that we have just rattled through quite a lot of information and we weren't able to get into everything. So if you have further questions, please do reach out. We'd be really happy to have a chat with you, especially if you're exploring how to implement this in practice. Next slide, please. I did want to just briefly call your attention to some upcoming webinars that we have that are really relevant to this topic particularly. We'll do another webinar when the guidance is released in Q2, but most immediately in April. We've just done a project with WWF and the Responsible Commodities Facility around credible Scope 3 reporting for investments in sustainable soy production in Brazil's Cerrado. It's going to be a deep dive on questions of traceability and MRV and certification, which I know a lot of you have questions on. So the report is published next month, and then the webinar will be announced at that point. We'll have it on our website. And with that, next slide, and I'll turn over to Alwyn for the Q&A.
That's great. Thank you so much, Catherine and Megan, and for everyone joining us today. So, as expected, we've had many questions flying in throughout this webinar. As Catherine has just outlined, it's a complex standard, a lot of breadth of the topics it encompasses. I've been working in the background to try and group the questions that have been coming in. So I'll try and pull out those themes and ask them as close to the questions we actually received as possible. If we don't get to them all, though, I guess the main message here is please do feel free to get in touch with Catherine or Megan or both. They'd be really glad to have a follow-up discussion with you. So the first theme that came out quite strongly, there was a real flurry of these questions towards the end there, is around when you have complex commodity supply chains, and particularly asking how the mass balance approach will work or will be permitted to work within those. So Megan, can I hand that one over to you?
Yeah, of course. This is a great question, and it's actually something that we've been digging into a lot in relation to a specific case study, which is soy production in the Cerrado in Brazil. And the key issue there is around kind of trying to map the land sector removal standards requirements against these real life supply chains. And particularly with soy, you have multiple stages of aggregation and export from Brazil, which can cause real traceability challenges. So in terms of defining the first point of aggregation within the soy supply chains, this is often sits with the trader. So the soy is collected from multiple farms and aggregated either within silos or processing facilities. And actually, within the specific case of the traders we were working with, they had very good traceability back to the farm. So in that case, we didn't need to apply the sourcing region spatial boundary because we had traceability back to the land management unit. But if you were going to apply the sourcing region spatial boundary, the way that that would work would be to select one particular processing facility that you had visibility of and draw a radius around that facility, which encompasses the sourcing of that facility. So you might choose 100 kilometers or 50 kilometers. And I saw another question about, who actually gets to decide what that sourcing region looks like. And I think the key thing there is really about matching the definition of the sourcing region to the production system. Some systems will have relatively small spatial boundaries, whereas others, the sourcing region can stretch throughout the whole country. And that could particularly be the case in some livestock systems. Will have very large sourcing regions and very, few processors within a specific country. So it's very context dependent. But once you've drawn your kind of spatial boundary around the first point of aggregation, the next step is to define they're called the attributable productive lands. So that involves identifying any productive farmland that could potentially have been tied to the production of that crop. So within the Cerrado, most of the farms will be producing soy. So most farmland will sit within that sourcing region. But in other commodities or supply chains, you'll need to exclude some of the land. So any land that's used to produce different products, or any land that is non-productive, so conservation areas, national parks, protected areas shouldn't be included within your spatial boundary. And then also there is a requirement for excluding any areas where credits have been sold. So that's another question that's come up in the chat, but it's one that's really difficult to apply in practice. And actually, if you are applying the sourcing region spatial boundary, that's often because you don't have strong visibility of the farms that sit within that area. So we think that's one that's going to need to be developed further over time and kind of working first to collect data on typical production practices and typical enrollment in supply chain credit sales. And then you can kind of move towards defining the spatial boundary over time. I don't know, Catherine, if you had anything else to add to that.
No, I think that was pretty comprehensive. Thanks, Megan.
Thanks, Megan. Really useful. So the next theme that's come out quite strongly is around removals, and there's a few points of clarification being asked for here. So, Catherine, I think I'll direct this one to you, and I'll split it into three subparts, but hopefully they won't take too long to answer. The first one is asking for an expansion on what you mean by moving from primary to empirical data when you're reporting removals, so what that looks like in practice. The second one is on the minimum traceability threshold for reporting removals, whether that's sourcing region or jurisdiction being permissible too. And the third then is around reversals. So just asking for kind of further clarification on the point on reversals there. So see if you get through each of those.
Sure. So primary to empirical. So empirical is essentially just more of a precise term. It really means you need direct measurement. The data has to be based on measurement and fact rather than sort of theory or extrapolation or modeling. There was a question initially around the definition of primary data. And for example, this is particularly relevant to soil carbon. Can our models accurate enough on soil carbon that you can use a sort of well-calibrated, potentially, soil carbon model as primary data and essentially avoid soil carbon sampling. And so this shift suggests, no, you need to do that measurement initially, which isn't to say modeling is out. That's another important aspect of accounting for soil organic carbon, for example. But it's just sort of re-emphasizing that you need to be directly there measuring at some degree. And they also talk about, they give recommendations and requirements around sampling methodologies, for example. So they're not expecting you to get direct measurement on every single farm, for example. In terms of minimum traceability, so the minimum traceability is sourcing region. It's not jurisdiction. So if you have visibility to sourcing region, you can report removals on productive lands. You can't report them on adjacent and proximate, but you can't report those anyway right now. And so yeah, it's sort of a moot point. On reversals, essentially there's just a difference between if you report a loss of removals in your inventory as an emission, so a direct sort of opposite, you had the removal and now it has emitted, it's turned into emission. That's how you report it in your inventory. If it is still in your scope, if it's still in your value chain and your inventory, then it just goes straight in there as an emissions the year that the reversal happened. If it is no longer in your scope, so this may happen the year that your supply chain shifts to another region, for example, or for whatever reason you lose the ability to monitor it, you have to assume a reversal. And then you just essentially report that reversal has happened. You call it a reversal at that point rather than an emission in your greenhouse gas report. And that's the guidance that they give on that.
Brilliant. Thank you. Very helpful. So the third bucket that we've had questions come through on is around science-based targets initiative alignment and how that tees up against this sector standard. And so I'm happy to begin answering some of these questions, and then Megan and Catherine, do feel free to chime in. So the question being, when do we expect the SBTI guidance for corporates to be adjusted if it's due to be issued in H1 of this year? And I think an important clarification point here is that the SBTI has two relevant standards here. The first one being the net zero kind of overarching corporate standard, but actually the much more relevant one for land sector and removal standards is the FLAG guidance from the Science Based Targets Initiative. And the updated standard you mentioned in your question, that's the net zero standard, the umbrella one that's due out in H1 this year. However, it says that companies still need to, when in the FLAG sector, still need to comply with the FLAG guidance, and the FLAG guidance kind of trumps the net zero guidance. So actually what will probably be more important is as and when the FLAG guidance gets updated by the SBTI. That is unclear as to a timeline yet, but I'd envisage that the Science Based Targets Initiative will really point back to the LSRS as much as possible in their FLAG guidance 2.0. So hopefully it doesn't leave companies stuck in that middle ground you worry about. And you ask about what, does there's other questions in here about FLAG emissions reporting. So for the SBTI, the SBTI did have a requirement previously that within 6 months of the LSRS, companies needed to be setting FLAG targets if they hadn't already. They put out a consultation late last year, which seemed to indicate they would be removing that 6-month window. And we haven't had full confirmation of it yet, but it seems that's the direction of travel. So unless there's anything else to add on those points, Catherine and Megan, I think I'll move us on to some other questions. One is around this proximate and adjacent lands point. So there was a question during the webinar as to, clarifying that hedgerows and agroforestry aren't included. And then the same attendee followed up saying it seems clear that they are excluded. And then it's more about the unintended consequences of this. So would love if you could comment on that, please, Catherine.
Yeah, so it's not super clear the way that they've done it in the guidance or the standard, in that, for example, as Megan said early on, they have expanded the definition, some of the spatial boundary definitions for example, for a land management unit to include adjacent and proximate lands. But that is more of almost a theoretical exercise in that they're signaling that is the spatial boundary, but it still doesn't mean you can report everything in it. It's confusing. And they also provide an interim requirement on how to account for adjacent and proximate lands. And there's quite a lot of detail there. It's not fully resolved. There's missing information, for example, on how close proximate lands have to be to the productive lands. But it is there, and so it reads as if you can do it, but then they are very clear in other places that the emissions and removals from those adjacent proximate lands are tied up in this forestry question, and therefore the LSRS does not currently apply to them, and you cannot report them in your physical inventory. They don't go so far as to say you shouldn't be doing climate mitigation here. In their FAQ, for example, on forestry, they just ask that you are transparent in reporting how you are accounting for forestry, for example. So you can continue to do that. They've given some indication as to what they think best practice is, and you can report it in your wider greenhouse gas report, but it cannot be accounted for in your physical inventory and therefore against your flag targets, for example.
Okay, thanks, very clear. But one kind of follow on here on this unintended consequences point, which is asking about the leakage reporting requirements and kind of, I guess, raising a concern that those reporting requirements may deter companies considering investment in regen ag at the moment, because pending further guidance and clarifying that point. Any views on that?
Yeah, I mean, it's a good question. And when I first read it, I was like, wow, they're really disincentivizing regen ag here. But really, actually, on reflective, it's quite vague. Vaguely worded, and I think they've left a pretty huge out for regenerative agriculture because first of all, it has to be a significant reduction in food in yield. They don't define that, but even in the reductions in yield you might see in the regen ag transition, for example, you generally wouldn't call them significant. So there's a question mark there. And again, I think that goes back to your ability to justify, this is where you justify. And then also, it says quite clearly that you don't need to report leakage if essentially your land management change or your removals are in service of long-term sustainable change. And to me, that's what regenerative agriculture is all about. And so to me, it seems pretty straightforward that, if that's the intent of your program, then that's the case that you make and you don't report leakage. So I'm hoping that I am worried about the adjacent and proximate lands, but I'm hoping that the leakage element actually isn't as big of an issue as it might first seem.
Great. Okay, I think we have time for one final question before we let you all go on the hour. So this one, it's just come in towards the end here. It's about asking if you only have sourcing region traceability, you can't claim the full impact of the reduction or removal, but rather just the impact it's had on the entire sourcing region's average. Is that correct? So Megan.
Yeah, exactly. That is correct. And that's one of the, I guess, implications of the need to define the sourcing region, including all of the attributable productive lands. So you need to include all of the farms that could potentially have produced that product. So you're right, as a sourcing region gets larger and larger, the impact of a regenerative agriculture project gets kind of diluted over time. And that we see as one of the barriers to, corporate claims from these investments in regenerative agriculture. But I guess it's important to note there are some kind of alternative approaches that are emerging, particularly under the value change initiative. So ideas around a stratified emissions factor, which would represent only a sub-proportion of the farms within that sourcing region, or potentially also improving traceability to get to land management unit traceability, at which point that kind of mass balance model could be applied. So directing those impacts to the funders.
Excellent. Thank you, Megan. And that with that, we will wrap up the webinar. Thank you again for joining, and particularly thank you for the really engaged, insightful questions. We hope we've gone some way to answering those, but just to reiterate the point that we'd really encourage you to get in touch with us to keep the conversation going. Thanks all.
Thanks, everyone.
Thanks.